So I do want to go ahead and get started. I know there'll be people that are popping on, but again, we're going to keep it to end at 10:30. So we have 26 minutes to give you guys just a really brief overview of kind of what's going on. So Kevin and Mark and I are going to just kind of through. We've got a real kind of light agenda that we want to touch on, really about like what's going on right now. The big Fed statement that came out yesterday. So Kevin, why don't you talk about kind of the wow factor in that Fed statement?
Well, yesterday was pretty unprecedented what the Fed chairman came out and said after the meeting. Basically, we've always educated all of our clients and realtors that the Federal Reserve doesn't directly impact mortgage rates, but the words that they do and the actions they take do give us good mortgage rates. And they're planning on holding the cost of money between banks, borrowing from the Fed, at near 0% for the long-term foreseeable future, probably through 22. And one of the most amazing word statements we've ever seen from a Federal Reserve chairman came out yesterday. I'll quote this: "We're not thinking about raising rates. We're not even thinking about raising rates." And that's a pretty darn good thing to hear for housing. It means we're probably going to see these historic rates we have now in a fairly tight range for months, if not year to 2 years to come, which they know that housing typically leads us out of recessions or potentially bad economies. So Federal Reserve, Treasury, they are basically printing money to buy money. Their printing presses are open and they're buying treasuries and mortgage-backed securities at an unprecedented amount every day to keep mortgage rates low. We're probably in a near term going to see rates stay where they are for quite, I would say, through the rest of the fall if we keep this trend going. So that's good news for all of us.
Yeah, no, it's great news. And like Bob mentioned, I mean, the low rates is really pushing people to get pre-approved. Mark, MJ over there, Mark Johnson, kind of where do you expect like mortgage rates? I mean, where are mortgage rates, like just briefly right now, where are they? And, you know, like we said, we expect them to stay extremely low.
Well, it's a range. I mean, you can see rates for, you know, for some borrowers, you know, we've been locking loans at 2.99% with a half a point cost on 30-year fixed, which is an amazing rate. We've been working with a lot of pre-approved buyers. And to Bob's point, again, there's been a lot of activity for all of us in terms of new buyers coming in to get pre-qualified. And so what we see with that is that the credit score can really impact where they go with the rate. And so, you know, Kelly, to your point, wow, you can do that 2.99 at a half a point cost. You know, there's some borrowers where if you've got a higher, you know, lower FICO score and you're putting less money down, or depending on if it's a condo or a single family home, you know, the rates can range anywhere from 3s to, you know, like 3.875-ish. But I'd say what, mid 3s mostly, I think.
Yeah, I mean, they're phenomenal. And then a lot of people are considering 15-year fixed rates. Those are in the mid 2s. I mean, it is just a phenomenal time. But I will say that there are a lot of what we call loan level price adjustments, not to get too weedy, but there's a lot of things that do impact the mortgage rate. You know, the loan to value, like Mark mentioned, the credit score. Credit scores are crucial. We thought we would just like touch briefly on rescoring and how much we actually work on credit boosting for clients if they're under a certain level, and it can make a difference of thousands of dollars in upfront costs as well as hundreds of dollars a month in their mortgage if they don't have a stellar credit score, as well as maybe not get a loan. So Mark, talk a little bit, just give a story about a credit score and rescoring and some tips.
Sure, yeah, just a couple. So we've got a new home project that we're working on up in Guadalupe, which is north of here. You don't know where it is. It's about it's about 800 total homes, 500 left to go. We've been lucky enough to be added onto that that big project, and the profile up there is a little harder to work with. And so I've seen a lot of credit scores in the low, like high 500s, 600 range. And, you know, we can take that credit report, take a look at what's driving the score lower. It might be a lot of debt. It might be a couple collections. And we're able to run what's called, run a credit simulator to kind of see, well, if we paid something down or if we could get this collection removed, we can move a score from, say, 580 to 620, 630, 640. And we were successful in helping one family getting a loan to be able to get their credit score bumped up from about 600 to about 620, 630, which is what we needed to do the loan. They were working with another lender who doesn't have those tools. And so we were able to take this family that was going to lose their house. I mean, literally, they already closed escrow with us about a month ago. They would have lost their home had they not, had we not had the ability to help them rescore and get their loan done. And we're just doing another one right now, kind of similar thing. So we're seeing a lot of that. And it takes more time to do those pre-approved. The nice thing is, we can really make a big difference. And so basically what we're doing is we're looking at the credit report that we pull. We're taking a look at how we can improve the score. Then we're going ahead and working with the client to get a new score. Process can take, 10 days or so, quick, and it really makes a difference for people. So I don't know if you have anything else to add, Kelly or Kevin.
Yeah, I know. I mean, the only thing I would add is the, jumbo loans. They do have added credit score requirements. We're working on one right now that's in the $3 million range, and the minimum credit score they need is 720, and she was 719, Kevin, right?
Yeah.
So, I mean, it's a hard stop. So
there's
what
no
we're
exception
doing
for
is,
one point.
yeah. I mean, you would think there would be, but there's not. So that's just one thing where we're advising her husband to add her to an existing account with Chase to boost her credit history, to give her more, to give her more data for credit scores to calculate. So we do become credit analysts at times, but it is so crucial. And the rescoring feature, you probably heard a little bit about it, but we do in the current times, it's really something we use more and more. We want to talk a little bit about the next topic we're going to talk about is being, Fannie Freddie Direct, and kind of we ran into one thing on an offer yesterday where the listing agent said the buyers have to have 20% down minimum because of the condo project, which, I, know this person, and I said, hey, I don't know where you got your information, but that's not right. And this is Fannie Freddie guidance. I just want to make sure we don't miss out on really looking at all the buyers if they have multiple offers, even if they're not 20% down. Please don't look at that as that they can't get financing on that. And so that brought up the topic. And Kevin, why don't you speak a little bit about what it means to be, Fannie Freddie Direct and what overlays are, because that's just another example of how, that wasn't true. It might be true for that particular lender, but not necessarily true as a guideline.
Well, that helps really, which helps us so much is we are a direct seller and servicer with Fannie and Freddie. So when we do a loan that meets conforming loan limits, Cornerstone keeps probably 98, 99% of our loans that we do now. So when we make a decision, it's our decision and it's our money that we're using on our credit lines to prepare it for Fannie and Freddie guidelines. And it gives us just so much more control of our situation. So we have the time to, fix a problem if there is one, or overcome a speed bump if we run across it, which I think a lot of folks don't have the ability to maneuver that quickly. If we're working with Fannie Mae guidelines and we don't quite fit that model, then we can maneuver into Freddie Mac guidelines instead. And the two agencies don't necessarily mirror each other in every respect, especially on 1 year versus 2 years of tax returns, how self-employment or rental income is calculated. So there are ways that we're able to navigate that I think some other non-bank and non-depository bank institutions can't do.
Yeah, I mean, and we call those, overlays. Like, there's a lot of companies that have overlays. Like, when we saw everything kind of changing in the mortgage industry, there was a lot of overlays with regards to cash out. There was overlays regards to added credit score requirements. There's some lenders that have overlays on down payment requirements. They have a 10% down added minimum. So if they were 10% minimum, they're 20% minimum. So there's all these interesting overlays. And so, one thing with being the Fannie Freddie Direct, it's quite nice that we're following directly the guidance, the guidelines that come from Fannie Freddie, as well as FHA, VA, USDA, and then jumbo, we're following directly with the jumbo investors. So I do want to just talk briefly, because we don't talk loan products so much, but I do want to just throw out that VA, back in January, VA did change their guidelines. and how powerful VA financing for eligible VA buyers, refinance. You can essentially do 0% down up to the amount that the actual buyer qualifies for. So if they qualified for a $3 million loan and they were buying a $3 million house, believe it or not, they could do 0% down, which is unheard of. There are some restrictions. If they have used their VA benefits, they do need to have full entitlement back and some other things. So I mean, there's not any catches. It's just if someone has already utilized their VA home loan benefit, then they do have a formula that kicks in, which is the old formula. But even then, it's still way less down payment than what you'd be looking at for a $3 million purchase jumbo loan. Even if you were subject to these down payment requirements with VA, it's still phenomenal, and the rates are phenomenal, and qualifying is very flexible. You know, VA has really come a long way. I don't know, Kevin, Mark, do you want to comment on anything? I know you're getting a lot of VA up there in the project.
Well, up in the valley, yeah, between Santa Barbara, Santa Maria, we've done a lot of VA loans, and just a couple other things. Nice thing too is there's no mortgage insurance, so the borrower is getting a rate of like I just priced one yesterday at 2.875 for a 30-year fixed rate, which is pretty amazing, and then they have no mortgage insurance, which is pretty terrific. So yeah, but you know, we were talking about overlays a minute ago. You know, one of the other things, there's a debt to income ratio overlays as well. So you know, we had a VA loan that was declined from a bank, and we took it over, and it was a perfectly good loan, but the bank had a debt to income ratio, you know, the lower, say maybe at about 49 or 50%, where, you know, we really believe in VA loans. We believe in how the VA requires that we calculate them out, and you know, we could go to a much higher debt to income ratio for that borrower. So my point in that is that, you know, it's not always the same with every lender, and you know, being Fannie, Freddie direct, being a more direct lender that we are, I feel like we've been able to have some, you know, opportunities there to help our buyers out. So
we had a great question on VA. Can it be used? It is a primary home, a primary residence only, and it cannot be used for a second home or an investment property. So unfortunately, there are some restrictions, primary residence only. You can do cash out refis with VA, but depending on if the veteran is exempt from a funding fee or not, and it can get kind of expensive for a refi cash out. So there are some times where VA may not be the best fit, but most of the time VA is going to be an amazing fit. And it's not harder on a seller. It really isn't. I've tried to overcome this kind of block in the community about VA. It really isn't. It's the same experience for the seller. You do have termite report and clearance, but the seller's not required to pay for it. The buyer can actually pay for that if and we've had many buyers pay for it because that's how important VA was for them. So we'll move on. One loan that you will never probably hear of not never, but not very often, is USDA, which is actually 0% down as well. And Carpinteria, Ojai, and the Valley are eligible for USDA. And Mark, I know you just were researching USDA.
Is also eligible because it's out in the middle.
Oh, yes.
Those out there, yeah. Just a couple things on USDA. It is a great loan. You're going to see more of it, like say up in the Valley, or, you know, out in Ojai. But it's also 100% financing, no mortgage insurance. It's a really great product. It's a limited fit because there's some income limitations, but they're not too bad. They're pretty generous. And then I was going to say one more thing about it, and I can't remember what I was going to say. But anyway, it's also a good product. So we're seeing a lot. I'm seeing more of those. So if it fits, it really works well.
Yeah, we closed one in Santa Ynez for a buyer that had good income. They just didn't have the cash yet for a down payment. They were able to get in with like less than $5,000, and it was lower payment than they were paying in rent. And they were flexible. They wanted to be in the Valley, and it worked really great for them. So again, just always thinking like outside the box. I mean, these are the times where we can really thrive and not think of all the roadblocks and obstacles, but think of all the good things that are out there. Another one, just to kind of think about, is the Santa Barbara Housing Trust Fund. They do have a down payment assistance program. It goes up to $100,000. They just lowered the rate on it. It was, Mark, you mentioned the flyer. It's 4.75 for the second,
Yeah.
which is really awesome. So it would be a great alternative to an equity line for a client. Instead of doing a HELOC for the second, we could look at doing the down payment assistance. And we work really closely over there with them, Jennifer McGovern and Yvette Longsbury, I think Longsbury.
I think also with that program, it was designed to be able to help borrowers afford a little bit more. And so, you know, when you get to a 625, 500 loan amount, you can add this onto it, and then the borrower actually gets to qualify for a little bit more, and it's an interest-only payment. And so as long as you live in Santa Barbara County and you work in Santa Barbara County, you know, it's a really good program, and especially now with less home equity lines that are available, it's for borrowers to pay a little bit less, higher priced home. And I know, again, we're talking in the 700s and not in the, but it's also a program we look at quite a bit.
So, you know, we were talking yesterday, Kevin and Mark and I, really about, you know, it's been 3 years since we transitioned to Cornerstone. So we are definitely ingrained in the Cornerstone family. And really, we were talking about like how grateful we are of being part of Cornerstone and a company that's, you know, really thrived through this kind of tumultuous financial COVID messiness. And so we just want to talk about kind of really some advantages that we feel that we have. So Kevin, why don't you just talk a little bit about, you know, our underwriter and kind of just touch on a couple things that we think are really important.
So one of the things that really makes us be able to move quickly and react quickly, especially in purchase transactions, is we have our own underwriter who works just on our branch's loans. So she knows Santa Barbara, she knows how our paychecks work from, let's say, a Cottage Hospital employee versus one of UCSB employee. They understand how our economics are a little different than other parts of the country. So our amazing underwriter, Don, is very, very in tune with our unique needs to this area. And I think that helps us navigate through things quickly. If there is a speed bump, we know how to get around them. It's nice having our own funder, our own doc drawing team. It's just, again, being part of a big lender that lets us have our own assigned team members really has been a huge benefit for us. I came from mortgage broker world for 25 years, and getting on with a direct lender with Cornerstone and joining Kelly and MJ has been a big boost for me and my clients as well. So I'm very thankful for that.
I always say to my clients, I always tell them, you know, that it's like, well, it's like the difference between like flying in coach in the very back of the plane or flying in first class. We're so lucky to have Don. I worked for a bank a long while back, and you know, the loan, once it goes to underwriting, it goes into this pool of underwriters in the Midwest, and you just never knew who you were going to get, what they were going to do, and what conditions they were going to have. And honestly, when it comes to closing time for buyers, and our processing team work closely together. We've just got the confidence of knowing what to expect from her, and she does of us. And it really makes a seamless process, you know, all the way to closing, which, you know, I mean, I know a lot of your clients have experienced that. So, but yeah, she's been terrific, and we really are lucky to have that difference.
Yeah, and one thing, and we have our wonderful appraiser, Steve. So we do have our own appraisal department, and we rotate between 2 appraisers. They're local. Steve is one, and then Don Sorensen's the other. And that is a really nice, we have a relationship. They know us, they know the properties in the area. So having local and just rotating between 2 is really cool. So we're really, really blessed. And thank you, Steve, for being so awesome too. We had a great question that leads us to the next topic, is really how can we help our buyers be more competitive with multiple offers? And we were going to talk about how can you get your buyers ready, prioritizing, that kind of is on that topic. So being fully approved. Kevin, why don't you speak a little bit to that? And Mark, you jump on as well.
Well, we have to thank our realtor team partners that allow us to work with the buyers in advance of writing offers. If we can get to them early, as we touched upon earlier, if there is a credit issue or an employment paycheck thing that we need to navigate around, by you guys sending things to us early, sending the clients to us early, we're able to get them literally pre-approved. So when we write a pre-approval letter, we have approved their credit and their income and their asset statements and their down payment and their gift funds and all the things that really can hold up a transaction down the line. We've already seen and considered, and we typically will be able to run a desktop underwriting system to get a pre-approval So when we put out a letter to you folks, it really does mean we've gone through more than just pre-qualifying and saying, yes, you've told us you make this income. We've seen it, we've verified it. And I think that gives our buyers a leg up when there are multiple offer situations, which we're seeing quite a few of right now.
I think also.
And then Mark, you talk about the fully approved. I wasn't sure if you were going to go there.
Well,
but.
Sure, two things. One is, one is on our loan amounts of 625 and below, or FHA and VA. One of the other things that we do is we run everything through automated underwriting first. Send a pre-approved. They've already been through automated writing. They approve eligible. They're ready to go, and we know that. We just don't want any surprises. And then the other thing that we have done quite a lot in the past couple years is we've put people who are going through the process, and it's a jumbo loan through it's a TBD approval process. So the property is to be determined, but we have an underwriter review the file and approve the file, and we get a loan commitment based on they're going to find a property. And when you get that letter, it's approved. I mean, really, Kelly, in a way, we can write without a loan contingency on those because we have loan approval, and that can help speed up the process. And it also really guarantees that, we know our loan is really solid. So, and that's typically reserved for buyers we know are absolutely looking at houses. They're going to buy within the next, 30 days or so, and, real committed. Because it's actually a loan. We're putting them through just like a loan. So.
Yeah, I mean, it's as close to a cash offer as you can get with a buyer that's getting financing, because we have all of our boxes not only checked and blessed by us as a team, but by underwriting, which is key. So then they can write without an appraisal, a loan contingency. It's up to them if they want to waive the appraisal contingency or not. We can get our appraisals done very quickly. Because we will pay more for a rush if we prioritize, obviously. And then purchase transactions are still being prioritized. We're still closing them in 30 days or less. So all of that is still very much happening. Yes, most every person in the mortgage industry is slammed with volume because of rates, but we're making sure we still always are going to prioritize your transactions, because that we know is really where we partner with you, and it's very important to us. So hopefully that answered that question. I think reputation, follow through, timely closings, all of that is so important in getting your buyer's offers accepted. And so we're really proud of our track record. And then the next question, I wanted to kind of just touch base about, I'm reading my notes over here on the side, about what do we need to know about the added requirements and changes? We really want to educate you. So Kevin and Mark, why don't you talk a little bit about the added requirements due to the COVID right now?
Well, I can do pay stubs. You can do bank statements. How about that?
Oh, thanks.
So for our W-2 employees, I feel like, we get to the end of the transaction and we're asking for the most recent pay stubs right before closing. Again, our processing team and our underwriter work real closely together, so we're able to get those in and quick. But just as a heads up, that's a Fannie Mae, Freddie Mac jumbo requirement, because they want to make sure that your income is still on track. And this is all kind of due because of the coronavirus. So that's one thing we're seeing. So pay stubs right at the end. It's not a surprise. We're prepping our buyers for it. We're letting them know that's going to happen. But that for our W-2 wage earners is something that's new and different. Kevin, over to you.
Oh, I get to give you guys probably the only not great news today. As of today, Fannie Mae and Freddie Mac have introduced new guidance on how we have to qualify self-employed borrowers. And we're just beginning to learn how to navigate these new requirements. So in particular, a self-employed person now not only needs to supply a profit and loss, which in years past hasn't needed to be necessarily perfect. They were oftentimes estimates. Now, the new requirements as of today are that the profit and loss statements must be actually validated by business bank statements. In most cases, they want to see 2 months of bank statements showing the deposits that the profit and loss year-to-date P&L is reflecting. And we are getting some guidance that we're able to use personal bank statements for, of course, the small-time self-employed person who doesn't necessarily have a business bank account. So This is new to us, and it's going to be new to every lender. This is Fannie Freddie guidance, and I think the jumbo lenders are going to follow suit fairly quickly. So if you have buyers that are self-employed folks, let us chat with them as early in the process as we can, so we can help them say, hey, if you get extra tip income or cash, make every deposit you can, so we have a month or two that we can help season in this money into your bank deposits to help support a P&L. And again, this is brand new guidance, so we're just learning how to get around some of the speed bump that's going to put in front of us. But it is happening right now. So self-employed people just got a little harder. Probably not forever, but for the near-term future here.
Yeah, and I know we bring up, Fannie Freddie and some other guidelines, and you're probably asking yourselves, like, we do so much jumbo in Santa Barbara, we're such a high-cost area, and why that's important, I think, to mention that, this guidance is coming down through Fannie Freddie, but so many jumbo products will mirror this guidance. They kind of look to Fannie Freddie as their mothership of like all these added requirements. They're going to mirror it, and then they're going to add their additional requirements on, like extra cash reserves, not using retirement as much as we used to for reserves. So just know that, like, when we're mentioning Fannie Freddie, a lot of this is potentially trickling into, if it's not already there, the jumbo world as well. So knowing that we have these added requirements is just so crucial to get your buyers to us as soon as possible, because then we can advise them, guide them about, like Kevin mentioned, putting all that, other income that you might not necessarily put into your bank account, but to put it in for the next 2 months, so we have the healthiest deposit trend that we can see. So I'm just going through, I feel like we touched on a lot of what we were going to talk about. We're here for you. I mean, right now, like, anything you need, like questions, any questions you have, like, please don't hesitate to reach out to us. It's right on the mark of 10:30. So I just want to talk about what we have next week. So our next week guest speaker is Danelle Stewart and Jenna Rogers. Danelle is partner of Mission Wealth. Jenna Rogers is a certified mortgage planner, a certified financial planner, a CFP, and a lot of other abbreviations behind her name. She's super smart. And they're going to talk about the CARES Act, which really, if I've been so focused on all of like the mortgage related stuff, but there's so many things that changed as part of the CARES Act: retirement contributions, student loan payments, tax filing deadlines, charitable contributions, hardship withdrawals. There's this clause about hardship withdrawals in your retirement account and not having the penalties, planning and investments. And so I really am excited to see their presentation and just continue to educate on all the things that have changed for us, not just mortgage related, but in industry, and stick into the inspire and educate really goal of these Thrivin Thursdays. So that's it for us. Kevin, Mark, thank you so much. It's such an honor to work alongside you guys. We're pretty awesome in our masterminding and staying together and really coming up with just as much as we can do to help people. So Mark, you have anything? Kevin, anything to say?
That's it.
That's it. Thank you to our real estate partners as well. Thank you guys for helping us move transactions along. We really appreciate all that you do with us.
Yes, thank you. And we'll see you all next Thursday. Bye.
Thank you.
Thank you.